Global corporate EV adoption has accelerated. Last year, sales exceeded 10 million units as battery costs fell and charging networks expanded beyond initial projections. This trend stops at the edge of any busy street in Dhaka. Here, the fleets used by corporations, NGOs, and pharmaceutical companies are composed almost entirely of traditional petrol and CNG vehicles. The government reduced the tax burden on locally manufactured electric vehicles from 89% to 33%. Over a 5-year life cycle, lower fuel and maintenance costs mean an EV generates 11.3 lakh BDT in savings compared to a petrol equivalent. The government has aligned the math, but corporate adoption still faces a behavioral gauntlet. In Bangladesh, B2B sales are blocked by institutional habits prioritizing legacy brands and existing routines over long-term efficiency. The first gatekeeper is the chief financial officer. Most procurement departments in Bangladesh prioritize the immediate sticker price, the capital expenditure, over long-term operating costs. If the upfront cost is higher, the proposal is often rejected before the savings are even calculated. This pie chart illustrates a major information gap. 68% of corporate buyers do not know that the 33% tax incentive exists. Without that data, the CFO cannot accurately model the vehicle's value. The second gatekeeper is the fleet manager. Their performance is measured by dispatch reliability and the total absence of vehicle downtime. These managers require an environment where charging is available on site. Outside of a few urban centers, Bangladesh lacks the public charging network and the certified mechanics needed to keep a corporate fleet operational. A fleet manager views an EV as an operational liability, unless they have absolute certainty that the vehicle can be charged at the depot and repaired within 24 hours. The third gatekeeper is the sustainability officer. In large multinationals and NGOs, this role is responsible for meeting global environmental, social, and governance mandates. Their decisions are data-driven. This flowchart shows the process. They require verifiable Scope 1 emissions data that can be audited and then formatted for international reporting standards. For these officers, green branding is secondary. The vehicle must be accompanied by the diagnostic software necessary to prove carbon reductions to global auditors. To reach these gatekeepers, EV brands are moving away from the traditional dealership model. They are building direct-to-corporate sales teams that understand institutional procurement cycles. The first two pillars of the strategy address the fleet manager. Brands are co-investing in on-premise chargers for their clients and providing strict service-level agreements to guarantee maximum uptime. Pillars 3 and 4 target the CFO. Specialized account managers now use customized calculators to demonstrate the specific lifecycle savings for a particular fleet. To address the fear of upfront costs, brands are offering 90-day risk-free pilot programs. This allows a company to test the technology's reliability before committing to a full purchase. Pillar 5 satisfies the sustainability officer. Fleet-wide emissions monitoring software is now bundled into the vehicle, automating the carbon reporting process. The final strategic pillar involves treating the government as a strategic partner. By co-branding with agencies like BETA or BRTA and pursuing government fleet tenders, a brand gains institutional legitimacy. This signals to the private sector that the technology is officially supported. The transition to EVs in the Bangladeshi corporate sector has become a challenge of behavioral change. The market will belong to the brand that sells infrastructure and institutional trust, rather than the vehicle alone.